Welcome back to the channel, everybody. Today, I wanted to talk about Microsoft. And the reason why I wanted to talk about Microsoft is because it was left in the comment section below. They asked specifically for Microsoft amongst a number of others. So if you want me to make a valuation video on a particular company, leave it down in the description and I will do my best to get to it. And also, there are a number of other companies that I'm going to be doing for this individual. So if you want more of this valuation stuff, hit the subscribe button. All right, launching into Microsoft. What are my thoughts on Microsoft? Well, Microsoft is a fantastic company. It's an amazing company. They have just an amazing return on invested capital. They have low debt. They have great returns on equity. And I am in love with the subscription model that they've been able to build over the last 10 years for basically all of their products. That recurring revenue is very, very important. Matter of fact, going all the way back to 2006, I had the opportunity to buy Microsoft and I didn't for $26 a share. And the reason why I didn't do it was because way back then, Microsoft was just an operating system. They had other products. They had, Microsoft Word and all of that other stuff, right? Excel, blah, 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 right? I did not invest in Microsoft at that time because all of their products were one-shot purchases. I thought that at the time, Coca-Cola was a better investment. And the reason why is because the turnaround time when you needed to purchase the product again was very, very long, right? Back in those days, you would purchase a key for their software and the software would start to run on your computer and it would run until the end of time or until the computer broke. So it was basically people repurchasing computers, right? That time frame. And it was, we'll say every 3 to 5 years. I thought that was too slow, and so I didn't buy it at that time. That's changed. When that changed, I should have bought, but I was asleep at the wheel. But what's ended up happening is that Microsoft, they've moved to a subscription model, right? So instead of purchasing the software, you rent it, right? Microsoft puts it in the cloud, you can subscribe to it, and you pay a monthly fee or an annual fee, whatever, right? You might get a price break for paying all of your monthly expenses upfront and one annual expense, but you're renting from Microsoft the software. The fundamentals of the company changed, right? And it became a much, much better business because of that change. So I really, really like Microsoft. I like the way that they're conducting their business today versus how they were in 2006, 15 years ago. I also like the acquisitions that they're making. I think the Activision Blizzard pairs nicely with the Xbox. I think it makes sense that they're pursuing those types of opportunities. They're doing a very good job of making intelligent, good capital allocation decisions. Like I said, they've got low debt. They're returning money through share repurchases. They're returning money through dividends. If you count the share repurchases, they're right in line with everybody else in how much cash they're returning to shareholders. They're doing about a 3% return per year. I'm trying to think of other things that they're doing, but I like the capital allocation that they're up to. I think it's smart, and I think that they're getting good mentorship from Bill Gates along the way. Microsoft, let's go to actual numbers now. Microsoft had $8.64 in free cash flow for the trailing 12 months. That's pretty in line with their earnings, their GAAP earnings. So they're doing fantastic, right? That is a lot of free cash flow per share. So let's talk about valuation here, because that is a lot. And so Microsoft deserves to be a large share price. I'm going to make some very generous assumptions here. Let's start by assuming that they're able to grow at 20% per year annualized. That would be an amazing feat, right? Over the last 5 years, Microsoft grew at about 17.5% per year. So 20% is quite good for Microsoft. And remember, they're a $1 trillion company, right? So sustaining a 17% growth rate is that could be very, very difficult. But we'll go with that very rosy assumption of 20% for a moment, because I want to make a point. So they're going to grow 20% for the next 10 years annualized. We're going to require a 15% rate of return, as I usually do. And we're going to assume that the terminal value of the company is based off of how much it's going to grow after that 10-year period. We're going to assume that it's going to grow at about 4%. So with those assumptions in mind, what we get for the company as a investment is that it is worth $189.28 per share. So what do we have here? Well, the stock price is sitting at about $280 right now. So even with a very rosy assumption of 20% growth for the next 10 years, the stock is overvalued, right? Let's bring those assumptions down a little bit. Let's pull back and say, okay, well, let's keep those rosy assumptions, and let's reduce our required rate of return until we get to today's valuation, so that we can understand what the market is implying about this company, right? So if you keep reducing that, if you reduce that required rate of return, and you go lower and lower and lower, at those assumptions, the current price implies a 10.5% rate of return is what you're going to get, which doesn't sound so bad. But remember, what I did was I made incredibly rosy assumptions. Let's go and take a look at what Wall Street analysts are saying about Microsoft. What they're saying is that that Microsoft is only going to grow at about 15.5% for the next little while, right? Which is less than what they've done over the last 5 years. And so that is probably a more realistic and a much more safe assumption. All right. I actually think that if you want to be very, very conservative, you should probably go with a 10%. But we'll stick with the Wall Street analysts for now, because Wall Street analysts don't tend to be super wrong, but they do tend to be overly optimistic. So I would go with more like a 10% return or a 10% growth rate for Microsoft over the next 10 years, but we'll stick with, for the rest of this video, we're going to stick with the Wall Street analysts and go 15.5%. So let's assume 15.5% annualized growth. That gets you to a price of, let's assume that growth rate, and then let's lower our expected rate of return again until we get today's price, so that we know what Wall Street is actually, what they're actually assuming about the stock, right? What's the rate of return that's built into the price right now? And what you do is you keep lowering that expected rate of return, and what you get is 7.25%. Guys, that is not exciting at all, right? At $280 a share, Microsoft is hot garbage. I mean, the company itself is great, but the investment is terrible, right? There's not a lot to be excited about there at today's prices. If I bump the expected rate of return back up to 15%, you get a price of $140 a share at the Wall Street analyst growth rate that's expected. That's in half, right? You have to cut the price in half, and that's when I would probably start to get interested, right? Microsoft is very, very, very overvalued, period, right? That's the message that I'm getting when I look at this company. I love the company. I love their business model. I love everything about them. I am not buying their stock right now. It is way, way, way too expensive. If Microsoft came down to $100 a share, I think that's kind of a no-brainer, right? But at today's prices, I'm steering clear. I'm staying away from Microsoft. I think there's a lot of room where it's going to come down over the next little bit. So take that for what it's worth. It's my thoughts on Microsoft. Again, we're just doing the numbers here. You might be able to say, oh, well, because of this thing, looking through the 10K or whatever, I think the growth rate of Microsoft is going to be X, right? And you plug that into your models or whatever. But just as a cursory glance, very, very, very overpriced, and probably not worth the effort of going through their 10K. That's just my opinion, right? But take it for what it's worth, because you might disagree with me, and that's okay, right? So anyway, that's it. So until next time, subscribe, and also stay rational.